Hello, everybody, and welcome to this Future of Funding. I'm Kevin Allen. I'm the Chief Community Officer at OpenExo, and this is, in fact, the third in our Future of series. If you want to see the recordings of the Future of, we have done two, right? They're this side of the screen. And if you would like to go and see those, you can see the link right at the top of the screen there, link.exos.2/Future1. And we have some awesome Future of events coming up in the next couple of weeks. So you can see those right now on the screen right over here. So you can see the Future of Learning for Kids on the 5th of June, as well as Future of Wellbeing, High Performance, and Mindful Recovery on the 18th of June. So do just go to the link that you can see on the screen right up the top there, and you'll be able to add these to your calendar so that you're ready to watch when they go live on those dates. And so this week we're going to be discussing the future of funding together with Elianne and Clarence. And so before I bring them up onto stage, I'm going to tell you a little bit about them. So that is Elianne, and she describes herself as intensely curious about life, and since she's been a young girl, she's always wanted to help change the world. So she started her career in strategic consulting at Deloitte in the Netherlands, and she has worked across many countries, cultures, continents, and industries on some complex problems and major turnarounds. And she's an adventurer at heart who lives to explore and travel, both at work and play. And she is a co-founder and the CEO at Epic. And then we have Clarence Tan. He describes himself as many things: polymath, futurist, technologist, entrepreneur, innovator, inventor, and the list goes on. Although he does say he would really like to be a Chinese comedian. And so we maybe talk about that a little bit. He's the chief evangelist and co-founder at Epic, and is passionate about exponential technologies, particularly in the areas of education, health, and seeking and sharing knowledge through humor, and is an avid keynote speaker and has really been spreading the revenue sharing message everywhere he goes. So I'm going to bring the two of them up onto stage. So Elianne and Clarence, welcome. How are you both doing today?
Well, very good. Thank you.
Excited to be here.
That is great. So Ellie, where are you calling in from today?
Calling in from the Netherlands in Europe, in the middle of the country. So not in Amsterdam.
Not in Amsterdam. And Clarence, are you on the Gold Coast?
Yep, I'm Sitha's paradise.
Floating up in the clouds.
That's right.
So perfect. So we're going to have a presentation from you to start off. And then after that, we're going to go into some Q&A. And so if you are on whichever platform you're on and you're watching this on, you can ask any questions. So you can stick those questions in the chat. You can also just say hi if you want. And we will then look at answering those once the presentation is done. So Ellie, am I handing over to you to present?
Yes, please.
Perfect. So over to you, Ellie.
Thank you, Kevin. And we're very excited to be here. OpenExo is one of our strategic partners, and we're both avid community members. We've been involved for a long time. Clarence even longer, I think, than I have. So it's an absolute pleasure to be here. We'll talk a little bit about Epic. Just to give you a bit of background, we'll start with why we created Epic, because it's all about our massive transformative purpose, as EXO has taught us. Before I dive in, let's introduce ourselves. So you met 2 out of 4 co-founders of Epic. We also have Chandresh in the UK and Matthew Still. We all have a lot of experience in the business investing, private equity space. And why we want to talk about Epic and different ways of fundraising is because we believe that we're too obsessed with equity fundraising. So if you read the papers, it's all about valuations and what companies' shares are valued at what price, etc. But if you look at it closely, specifically for early stage companies, only 1% of companies get funded by venture capital. And if you then look at the listed companies, only 30% of them were venture backed. So think about that, right? If there's only 1% of companies being funded by venture capital, what happens to all the rest? And this is why I want to talk about the future of funding, because there's so many ways now in which you can actually raise funding without doing the equity game. It's only just one of the options. And we want to make people aware of that because we believe the alternatives are as attractive and applicable, and maybe even more so in the future than just the equity game. So here's a simple table of the things that are available to people nowadays. With that, the trick is probably to look at this from a type of a funding perspective. So the type of funding could be grants, the type of funding could be loans, the type of funding could be convertible debt, which still relates to equity. Then you have equity, and then there is something that we call revenue-based financing, which will put under venture debt. Now, for all of these, apart from the grants, there's a vehicle for this that's called crowdfunding that you probably have heard of. It's one of our favorite models because we believe in democratizing access to investments. Now, I spoke about venture debt earlier. We believe venture debt is going to be part and parcel of the future of funding because it's tapping into a market where we have equity and the equity game, making sure that there's a lot of traction around startups and higher valuations every year. And like there's an abundance of venture capital firms seeking investees. So there's a lot happening in the equity space, but naturally startups aren't always aligned with the goals of venture capital, and naturally not all startups actually fit the buckets of venture capital at the right time. So venture debt is an alternative space in that, where you look at it from a debt perspective, so really the loans. And the difference between venture debt and venture capital is that you don't actually take equity. So it's slightly different in that the equity game is based on a 10x out of a portfolio. You need 10 startups. If you look at it from the basics, the rationale is, or the math is, you have 10 startups, and Clarence, jump in if you want to add. You have 10 startups. Out of those 10, 5 or 6 of them will completely die, like nothing will return in the next 2 years. 2 or 3 will have a 1, 2, or 3x return, so tripling or doubling your money. And the last one will actually give you a big return, and then you're talking about 100x. So that on average gives you then a 10 times return over the 10. Now, we don't really like that model very much because it's based on companies completely failing, right? And it's based on the fact that you need like $1 billion market to even be attractive for venture capital. So all those companies, the 99% companies, could also be backed differently. And we believe venture debt is going to be a thing in the future. It already is in the States. They're leading the way in this. But we want to make sure that we need to actually look at alternative funding and bringing that as an edge initiative, if we look at it from a market perspective and an EXO perspective, into the core, right? So what do we need to do that? We need successful deals structured in a different way. And so successful deals for us is leading and innovating founders, winning products in growth markets, and backed by innovating investors who are willing to do this thing differently. So out of those, I think Clarence can take over from here because he's one of those innovative investors who's been in this game for a long time, and we have particular views. So Clarence, I'll hand over to you.
All right, cool. So thank you, Ali, and thanks, Kevin, for having us here. So this caricature shows you, we're so focused on creating value for shareholders that we destroy the planet, right? Which is one of the reasons why we created Epic. So I've been angel investing for a very long time, over 20 years, I think. So essentially, what we found was that most of the time you have a startup coming to you with a great idea, but that's all they have, an idea. And that's the problem, right? Because they put a very high valuation because they don't want to dilute their equity. And obviously the investor, the angel investors or the VCs will try to squeeze them down on a value that's not even real, right? Nobody knows, what the value is going to be, in 5 years or let alone a year. So that's why we basically wanted to move away from the model of providing a valuation that is really based on hypothetical values, and at the end of the day, there's no deal done. And the other thing that's driving this is obviously the world needs all the help we can get. How do we fund projects that will progress humanity and move the world forward? As you can see from this slide, I mean, to achieve the SDG, you would need about $3 to $4.5 trillion a year. Elianne, move on. And the problems with equity investing, I mentioned to you, the valuation is one of them, and then misaligned goals, right? Because if I put on my VC hat, as Ali mentioned to you earlier, I'm looking for an exit, right? I am not necessarily aligned with what you're trying to do to change the world and make it a better place. I'm just looking for the next person that's going to buy me out at a higher price. So I'm looking for an exit. And then there's the other problem of trust, right? If I invest in equity, every penny that the founder spends impact me, right? So, why is he hiring? Why is he or she hiring his brother-in-law? Or why is he buying a Lamborghini? Might be the best thing for the company, but it's coming out of my pocket, right? I won't see a return until, they pay out a dividend or there's an IPO or an exit. And this is why, we decided going down the path of the revenue share, where we don't have to worry about the bottom line. So we are not looking for unicorns, right? We are basically looking for zebras, because we don't need that 15 to 20 times return that angel investors or VCs are looking for. This is why, if revenue sharing, we get our money back sooner, and we essentially are able to provide the investors the same kind of IRR that they would get from a VC investment of a target of about 38% IRR, 5 times return within 5 years. So our MTP is accelerating impact by democratizing investments on both ends, both finding projects that are doing good, and also investors who want to, basically use their funds to do some good in the world. Because I think people are tired of investing in food apps, and they want to see their money move the world in a positive direction. Even if it fails, at least you move it forward towards a noble goal. Obviously, we want to minimize that. So the benefit to the investors is that you're getting projects that are doing good with investment, meeting the SDGs. You also mitigate the risks, but just like I said, you get the money back sooner, which you can then reinvest into other projects. And align the investors with long-term goals. I'm not looking for quick exit, because as long as the returns, the revenue keeps generating and you get a percentage of revenue from it, essentially you would be happy to continue down the journey with the founders of the companies to basically achieve their MTP, their noble goals. So the benefit to the startup is that they don't give up any of their equity. There's no dilution of equity. They had the freedom to manage the company they see fit, the way that they want to run it, and they are aligned with the investors. So these are all very important points for basically startups that are looking for investment. Finding a investor is like finding a partner, right? So you need to make sure that you are basically getting the right one, because it's going to be a long-term partnership. The criteria for investment via Epic platform is the companies has got to be near or at revenue. Obviously, if you're a long-term R&D company, we might not be the right partners. And then the second criteria is that we want to make sure you're doing good. So you should meet one or more of the United Nations Sustainable Development Goals, which all the 192 countries of the United Nations have agreed to try to achieve by 2030, back in 2015, including North Korea. So that's the second goal. And the third one, which is highly linked to the OpenExo movement, is that the company should be growing exponentially, so EXO certified and or have high margins of at least 30%, or else we wouldn't be able to do a revenue share model. So that, in a nutshell, are the main criteria. And the inspiration for this was a project that I co-invested in back in 2013, a game project. If you guys play computer games on Steam, I was trying to help a friend who was trying to raise some funds. It's a game called The Forest. We invested in this game, and the structure of the investment was very interesting. Let's say they needed 100 grand to finish the project off, and the deal was that we would take the first 100 grand they made from Steam. So Steam is like the iTunes store for gamers, and they take 30% of the sales of the games. And they launched this game back in 2014, June 2014. And essentially, the next 100 grand they made, we took 50%. And then after that, we took a small percentage. But that small percentage, this incentivized them to make the game better, because the game was launched in alpha. And it didn't go into full version until, I believe, 2019. But we were getting returns, and we asked to getting returns of anywhere from 25% to 200% return per month on our original investment. So seems to be the revenue sharing model seems to be a really good model for us to follow. I think Ellie, you're going to take on the rest of the. So go ahead, Ellie. You want to talk about?
Yeah, I think the real big differences are that we focus only on impact, and that we utilize revenue-based financing as the financial instrument instead of equity or instead of a pure loan. And that really helps to align investors and founders to make the best possible impact, right? And we believe by doing good and doing well, we actually create an exponentially positive impact as a community. So this is why we're also really excited about partnering with OpenExo, because I think we are very much values aligned. We leverage the model as well. So for us, it's kind of like a no-brainer. It's like, why would you not invest through revenue-based financing? And then why would you not invest in impact? Because who needs another Uber, right? So if you are an accredited investor and you want to invest, think about whether you want to invest in exponentially mission-driven companies. For the record, research has shown that purpose-driven companies outperform the market in terms of market share and in terms of revenue, as opposed to non-mission-driven companies. So totally worthwhile. The beauty of the revenue share model is that you receive company revenue instead of equity over time. So it's not like you're locked up for the next 7 years and you're hoping for an exit, and your equity share on the cap table keeps declining to like 0.01%. But you get your money back over time, every month or every quarter. You can pull it out or you can reinvest it. It's basically the rental model, only in startup investment form, right? And what we do is we do the due diligence, we structure the deals, we find the deals, we structure the deals, and we help you invest. And then we actually handle the administration, reporting, and payments from the investments for you, as well as put support structures around the startups. So it is still a high-risk investment space. It's not like these guys are going to or these gals, everyone's going to just make money by dreaming it up. It's still high risk. So what we also do is, through OpenExo and other strategic partners, ensure that whatever the startups are needing in terms of advice, in terms of market connections, they can source that through the crowdfunding model that we have, and that we can source mentors to support them. And the beauty of the model for you as an investor, potential investor, is that we only make money if you do. So if the startup is not actually returning any capital, which would be odd given that they would be at revenue, then we don't get any money unless you do. So we only touch 10% of revenue share received coming back into your portfolio. And if there's nothing coming back, then we all lose, basically. So again, it's all about aligned incentives. Really, that's to wrap up. If you're not an accredited investor, that's totally cool too. We would love for you to join our community as well. We're close with OpenExo, so you'll see us regularly on these platforms with them, or in calls and as an ambassador, etc., because we are totally backing the concept. But we'd love for you to join us as well if you think revenue-based financing is part of the future, like us, and if you can help us find deals, perform due diligence, or mentor startups. We'd love to have you join us. That's it, really, Kevin, from a presentation perspective. Do you want to jump into the Q&A?
Kevin, you're muted.
And this is
what it means when I'm muted. It means I have to head over to the EXO Economies Discord and make it rain. That was a rule we decided on during our economy town halls. And I haven't done it in such a long time. So, man, thanks so much for the quick presentation. And so today's Future of event really it's focusing on the future of funding and your take around revenue-based funding. And now we had a few questions from folks actually beforehand. So if you are on whichever platform you're on, you can ask questions. So please do go ahead and do that. I'm going to start with some of the questions that came before this event, and then we'll head into some of the live questions. And so the first one was just really about how important it is for organizations to actually understand EXO in order to actually receive funding. And so I think that question was really around what you're doing at Epic, but I guess we could also take it further in terms of actually any organization that is getting funding. But that would be an interesting question for you to answer.
Yeah. Shall I take the first one?
One of the things to Kevin forgot to mention is that with our model, we can actually invest in NGOs because we're not looking for an exit. As long as the NGO produce revenue, we can fund.
Yeah. On the question in terms of EXO certified, so it has a few flavors. If you're a potential investee or prospect startup, we ask you to do the EXQ, right? Because there is exponential scalability required to return a 5x to investors. The reason why we have the 5x as a criterion, as a first filter, is because if we want to actually shift the big pools of capital, we need to be able to outperform or perform on par with existing high-performance venture capital, right? So if you look at the market, if you look at the equity, we're in a similar space as venture capital. If venture capital does an 38% IRR, which is extremely high for venture capital because usually they do much lower, then our deals need to be structured based on that particular target as well. Not to say that we will make it in terms of the investment, but that potential needs to be built into the startup, right? And this is why the EXQ is important, because the exponential scalability is there. Plus, if you do the EXQ, they will ask you, right, what is your massive transformative purpose? Which is really important because we love to see the SDG alignment, the impact embedded in the business model. Because then, if the startup does well, the world gets better. And if the startups and the investors do well, everyone's happy, right? The world's happy, the investors are happy, and the investees happy.
Absolutely. And that answer sort of points towards one other question, which was asked is, does the future have a place for only profit-driven organizations? Of course, this is just an opinion, I guess. But, do you think that the future has a place for just profit-driven organizations? That's all that they're out for.
Clarence, you want to go first?
Yeah, no, I don't think so. Definitely, not aligning with the whole OpenExo concept too, right? Because it's purposeful corporations. I mean, if you know about the history of why profit-driven companies only basically are concerned with the creating value for the shareholders, it goes all the way back, I think, to the Ford versus one of their shareholders, Henry Ford. Henry Ford wanted to basically pay top money for all the best engineers and so on, which is why Ford was known for its quality. And I think they're building a new factory, and then one of the shareholders, which actually became the founder of, I think, GM, sued Ford for basically overpaying staff, right? And said that he should be more concerned about the shareholders. And unfortunately, the Supreme Court of the US founded for the shareholders. And that's why the whole impetus of creating value for shareholders at the expense sometimes of society. Before that, corporations were, there were very few companies, but the companies were meant to provide some benefit to society, right? And that's the purpose. And so that's why, well, as you can see now, right, we're having climate change issue. We don't really value the real cost of profit-making companies. which is why I think there is already a kind of systemic change with benefit corporations and so on.
Yeah,
so
agreed. And you're talking to the converted, I guess. So I back that with Clarence. I do believe the further you are removed from the beneficiary of your impact, the harder it is to stay purposeful, I think. So the intermediaries of the world, well, like B2B, right? It's hard to be super purpose driven if you have B2B, but there's still needs. Companies still would have needs to service, I don't know, payroll or basics like that. So I think there's always going to be some room. I think there's the responsibility that companies, and with companies, like what are companies really? It's just a group of people working together, right, towards a common goal. So I think if you look at it that way, I think people, especially now with post-pandemic or mid-pandemic, depends on how you look at it, I think people are so much more aware of what business is doing for themselves, what they're doing themselves, how they're doing things. The movement towards impact is gigantic. It's the fastest growing space in investments in all asset classes. So it's not just particular green tech or clean tech. It's across the board. You're looking at pension funds moving because consumers are much more. So you vote with your dollars, right? With your euros, with whatever currency you have. You vote as a consumer, and then you can vote as a citizen. And so that's how I think it runs. But to be completely devoid of any particular goal, I think an awareness of your impact on the world would be.
Yeah, absolutely. And you mentioned dollars and euros. One question that came in was, obviously a person maybe who's into crypto or read books like The Price of Tomorrow, saying that there's a number of predictions about the fact that with all this money printing that's happening, that sort of fiat's just going to fall off the edge of a cliff. Now, maybe you're not well placed for the answering this question, but what does that do to the future of funding? How does that future look?
Well, I think that's not actually completely mutually exclusive, right? I mean, look, the Chinese creating the yuan, it's a fiat becoming digital. So I just read Robert Reich's comment about avoid cryptos because it's easily manipulated, and there is no way of actually ensuring that payments are done above board and so on, right? I think that there obviously is going to be some disruption, and there's some different models people are discussing right now in terms of how do you actually share the love, right? Share the abundance of what technology has provided us, so that we have a more equitable spread of value to everybody else, right? And just printing money and everybody fighting for the scarcity of money. So I mean, there are no easy answers on that. I mean, people have looked at basic income and other type of deployment. I think the two things here, right? One is functional. I think the e-currencies are here to stay. So the Chinese are already kind of experimenting with that. I spoke to a colleague of mine from the academia, and he's a consultant now to the casinos in Macau, and they're very concerned that the e-yuan, the Chinese e-renminbi, will now be implemented in Macau. So, the Chinese government could theoretically know how much everybody spent in the casino. So things that were kind of dark now might actually get lit up. Whether you like it or not. But I don't have full answers to that. But I think there is a place for it. Just not sure what's the fine medium between control and the ability to be anonymous in using your currency.
Yeah. I think crypto is just one innovation in the finance and currency space, and I believe just with revenue-based financing, it's gaining traction because it makes sense. It works, right? It's based on business economics. With crypto, we're actually we had a call literally yesterday, just backtracking. We had a special roundtable yesterday on investing for income and what that means if you look at it from an impact lens, right? And we had a professor on there, and he said, on average, the distance or between an asset, so whether that's a factory or a company or someone, between an asset and the actual asset owner, whatever form that takes, right? If you buy some shares on the market, you're actually an asset owner. There's usually 17 intermediaries. 17 companies, organizations, or people taking their own cut. 17. How inefficient is that? Right?
Yeah.
So if you think about it that way, it's like, well, there's so much opportunity.
But it creates jobs, though.
It creates jobs, right? It creates a lot of wealth for a lot of people. Question is that fair, right? And I think what blockchain does is actually both democratize the access to those things and remove those intermediaries and make it really, really simple to track transactions, etc. And take out 15 probably of the 17, right? Because something needs to go on the chain and then off chain, whatever. But yeah, I think it's a really exciting space, I think. And you know, if you are worried, my advice would be, okay, start hedging your bets. What are you doing as an investor to hedge your bets if you think that's the case? What are you doing to diversify your portfolio?
Yeah, absolutely. And now, Ellie, you mentioned, you know, the roundtable that you had yesterday. Perhaps you want to just share a little bit of info just around those events that you are hosting, and we'll then head over. I see there's some questions from a LinkedIn user. I can't see who you are because of your privacy settings, but we'll go to those. But yeah, if you could share a little bit more about that for those who are watching.
Yeah, sure. So we have our own community. It's really focused on people who believe in revenue-based financing for impact. So we filter quite heavily on impact. What we do is to bring the community together is to host roundtables where we have a similar setup like this. No presentations, just organizational style, conversational style discussions around particular topics. So the last two were around post-pandemic impact investing. And we had people from Europe, Asia, and Australia just presenting their views and both the commonalities and the differences across the globe, which was really fun. And the last one was particularly around income, because this is now a low interest rate market, right? Across the globe, interest rates are historically low. That also has an impact, right? There's a reason for it, because they want you to spend money that's been invested to stimulate economy, right? And economic stimulation needs velocity of cash. So you gotta make it roll. So this is why interest rates are low. So people want to spend, right? There's no point in saving because there's no money in it, but you can still invest for the long term in a low interest rate market. And if you're smart, you do this with impact, so that not only do you sleep better, you get karma points. Your money also makes money. So that's what we talked about in the last few roundtables, and we love it. It's basically an open forum. We believe in the adage of rising tide lifts all boats. So, you know, the more you engage with conversations around these topics, the more you look at future trends, the more you start engaging with something. And then ultimately, when you put money on a trend, you focus on that, right? So you learn. And if you learn yourself, if you build connections in the space, and if you invest in the space, you've already won, because you've upskilled yourself. You know, you're richer for it. We believe in richness in form of connections, and in form of personal talent, and in the form of capital. So there's an abundance of people here with so much talent. It's like amazing. We'd love to keep tapping into that. So that's what we do.
Cool. Awesome. So it's epichub.com. Is that correct?
No,
epichub.org. Sorry, .org. And it's actually behind both of your names. So do head over there and take a look. So from LinkedIn, we have someone who's asked a few questions. I think it might be the same person, very much around what you guys are doing at Epic. Just asking, what does EXO certified mean in the context of eligibility for funding? Is it a requirement that the founders are certified in some way? What does it mean?
Oh, we would love to have the founders at least have awareness of the Exo Canvas and the methodology, because we do believe in the fact that to create exponential impact, you need exponential tooling, right? So if you don't build into your business model, it's going to be a long road to scale. And we'd love to see that exponential scalability with impact, because we believe that's exactly where it matters the most. We don't care if your ride-sharing app is going to scale exponentially, but if you're having an impact on, I don't know, learning disabilities with children, we want to see that across the globe, and we'd love to have an exponential model that then helps that, right? So we'd like to have an awareness. There's no need to be certified as a founder. We'd like to see the EXQ score. Oh, we just lost Clarence.
I think we just lost Clarence. He'll be back.
Some shark is biting a cable in Australia underneath the water. AI is easy. When you look at it, AV is hard. So anyway, all good. So no need to be EXO certified as founders. We'd love to have our community members that actively participate in looking for deals or do due diligence or being a mentor, understand and preferably have EXO foundations, even the consultants and coaches, because we believe, we need to help each other, and we're very much working based on trust and collaboration. So that the EXO certification helps in that.
Mm-hmm. Absolutely.
Speak the same language.
Yeah, exactly. Then the next question is, could you give some examples of ventures funded by Epic?
Sure. You want to take that, Clarence?
Yeah, so the first one was another project I was involved in, GoGo Tech, which is Kevin, you actually tried out the chair. It's a smart portable wheelchair that we are making out of, basically a company set up in Thailand. And that was kind of inspired by one of my close friends, who basically had a beggar outside his home in Thailand, that American guy that lived in Thailand was a Cambodian farmer that lost his leg in the mine. And at the time we were making hoverboards, and basically we were trying to make it for commercial use, and we had already been able to control it through a mobile phone and remote control it and so on. But and we gave that person a hoverboard, but if you don't have, or self-balancing wheel, if you don't have a leg, it's kind of still hard to use it. So then we thought, why don't we take the guts of this out and stick it to a wheelchair? And that's how Abby, this smart, portable, affordable wheelchair, was created. So that was the first project that we kind of funded through Epic. And what we were trying to do in that particular project, the MTP for GoGo Tech, was creating an inclusive society until everybody can walk. So that was the first project that we did, and that one was a bit different because it's actually a hardware project, right? So the margins are not as high as a platform software-driven project, but there are plans to make that particular project to use the data that's accumulated from the chairs themselves, and to basically make it more commercially viable. So we are able to make a chair that we are hoping to retail at the price of an iPhone, a top-end iPhone for $2,000 that can follow a line, and basically you can remote control from your phone or from a device, a whole bunch of amazing stuff that's on the chair that would allow person that has mobility challenge to be able to be included in most of the activities the family members would like to do. Because if somebody is disabled in your home or mobile challenge, then the whole family is kind of grounded too, right? So that's the impetus for that project. Other projects that we have looked at, we look at a number of projects, but it's kind of difficult at times to, with COVID and all that, to get the investors and the projects all together in time and to get them launched. But at any one time, we would have like maybe 4 or 5 projects we're looking at, and it takes time to do the DD and the technical due diligence and the financial and so on. But they're coming from all over the world, really, particularly in Asia and Europe, I think.
Yeah. We're very keen on bringing revenue-based financing to Europe and Asia. Europe, because there's a lot of impact focus here, right? It's kind of like, it's such a normal thing here. People are like, yeah, of course, makes sense. So there's a high awareness. And Asia, because we believe that's where the future is. Basically, the technology is cheap there, the access to talent super affordable still. And this is where the biggest markets are in the world, really, and where the capital sits. For context, we only started last year, so we've literally done 1 deal. We are a startup ourselves, which sounds, interesting. But this is also where we look for collaboration with excited, innovative investors and investees.
Absolutely. And so the next question there on LinkedIn, and if you have any other questions, please do post those on whatever platform you're on. Just says, who typically invests with Epic, and what are the eligibility requirements to be an investor?
Yeah. So whilst we have the desire in the MTP to democratize investments, due to licensing restrictions, we can only take accredited investors. Accredited, or I think the other word was qualified investors. Depends on the jurisdiction, but if you look at it, it's usually Sorry?
Sophisticated investors, I think, in Australia.
Investors, yeah. It requires a certain amount of capital. Usually, you have to have a net worth of over $1 million, I think, depending on the jurisdiction, or make $250,000 a year or upwards to qualify as an investor, as an eligible investor. It's different for companies, so it depends. We've worked mostly with individuals that are high net worth or are accredited and or sophisticated qualified. So in the future, when we're full scale, exponentially growing, and we have the crowdfunding license that we want, that's when we can take retail. And this is when we want to actually open up to everyone and anyone, anywhere in the world. And we also believe blockchain might be part of the solution to actually provide for that.
Awesome. Clarence, did you want to say something there?
No, well, that's our MTP is democratizing investment, and unfortunately, at this point in time, it's still sophisticated investors and accredited investors, but we really want to bring it to everybody. But that's why we're working closely with OpenExo and other partners. We want to educate either innovators and or investors on the three things, right? What EXO, what being exponential is all about, right? In terms of growing your businesses or transforming the world for a better future by growing exponentially. Secondly, what are SDGs? And thirdly, what's revenue-based investing? So these are three things that we're trying to basically get across to people to join us, and it's a challenge, right? Because you have investors, but they don't know what EXOs are or what revenue-based sharing is. So the OpenExo community is great because they already know SDGs, they already know EXO. It's just investment that we need to kind of educate them on, and that's what we're trying to do.
No, absolutely. Another, I guess it's a comment that comes from LinkedIn, and we'll have to go onto LinkedIn itself to actually see who this person is, because it just says LinkedIn user on our stream side. It's just saying would love to chat about how you determine the criteria for the range of investment of venture types, right? And essentially saying no impact washing. What is it that you do to actually to ensure, hey, there's no sort of impact washing, MTP washing, or whatever the case may be?
Yeah. And look, and this is the hard part about the impact space. I mean, if you start digging into it, like, give me the one definition of an SDG, right? And then how does that translate into operational requirements for companies, or how do you measure this, right? I've worked with the Dutch Development Bank, and there was a team of about 90 people working on impact measurement for the Dutch Development Bank, trying to measure impact. Like, it's hard, it's big, right? So what we've done to make this operational for us is two things. One is in the due diligence, we check whether the company actually has built it into their business models. Like, is it part of their corporate governance, that they have an impact focus? And we ask the company to say how they're having impact. So what's the story? Not just the MTP, but also which SDG and which indicator under the SDGs or indicators, because there could be more than one, are you hitting, right? You can get into the debate of economic development being impact in itself, which to me is true. But if you then look at what impact investors are looking for, it's very much around actually having impact on the fiduciary group at that level. So, it's not black and white. It's totally gray, and it's totally a sliding scale. You can even say doing no harm could be impactful because it's economic growth. So it's wicked. It's weighing that up. What we've also done in the past is with companies that were like, oh, this is a great opportunity. It's a platform play. Is it really doing good? Right? And then you start testing that with people. You start having conversations. And through the conversation, you learn it's not impact enough, or it is impact enough, right? We're currently in discussions and due diligence with a company that does food waste, battling food waste. And we think it's great because it's benefiting merchants, it's saving food, right? And it's benefiting consumers that might not necessarily have always access to those types of food. So those types of things, like that's common sense, right? But what if you're a platform that leverages an abundance of labs, right, to do particular tests or to run particular prototypes? You could also prototype a new type of gun or some sort of weapon, right? And that's when it becomes gray. And so this is where we need to feel it out with the community and have discussions with our investors, because if the investors are not interested, we can push as hard as we want. No, it needs to be a match. It's like dating. It's really hard.
Yeah. No, absolutely.
Fun,
so
right?
I just quickly popped over to LinkedIn and I saw that was Jabeen who's been asking those questions.
Hey, Jabeen.
Perfect there. The next question I wanted to just ask is, I mean, obviously you're really interested and really focused on revenue funding. Do you still feel that there is a place for the other funding models, equity, debt, etc.?
Well, definitely. I mean, I'll let Ellie answer the rest of it. But the thing is that we have a natural ceiling on how much we can raise. So we come in at a stage where I think is still kind of after the angel investment round, or even maybe at the angel investment round, because we are looking for a 5 times return, right? So if you raise $2 million with us, we are expecting to get back 10 million, right? So there's already a natural ceiling in return, right? So that means your revenue got to be like 100 million or something within 5 years. Can you achieve that? So that's why it's a mix. Even in GoGo Tech, we only raise a portion of it through revenue sharing, and then the rest of it might probably be driven through equity again or some other form.
Yeah.
But then you're better, you're at a better, by that time you would have an MVP hopefully, and you have a better valuation than you would initially, because initially you have nothing, and then you go out and say I'm worth X dollars, and everybody's going to beat you down.
Yeah, and totally. I think there's instruments for every stage. Equity is one of those things that it seems to be the logical thing, but it's actually not necessarily the most logical thing. Specifically not for impact, because that's the first thing that drops off the negotiation tables. Like, oh yeah, impact, whatever. Let's focus on the money, and that's the dynamics of that particular game. Having said that, revenue-based financing can be complemented by equity. And we do think risk capital is always required at any stage of the growth cycle of a business, right? So it's all about the risk profile that you have as a company and how you want to, where you find that match of investors. So banks, for instance, have a super low risk profile, right? They don't want to have any risk. So this is why they ask you to put your house on, your personal liabilities. Like if the company goes down, your house comes with us. This is their risk appetite. Whereas you look at angel investors, they have a super high risk appetite, and they can even invest in an idea and a team rather than a product and a market. And so the loans thing, like you now have a lot of non-financial institutions offering loans for slightly higher interest rates because it's such a low interest rate market, right? Totally still applicable. We're big fans of crowdfunding. Because then everyone can back everyone, right? If you put your money in the bank now, it's literally worth less in a year's time. So you're better off taking a punt and maybe getting a few percentage more in terms of interest from helping out peer-to-peer lending, for instance, right? There's nothing wrong with that. So it depends on what you're looking for in small, medium-sized enterprise that have been running for 10 years, like your corner stores potentially, or particular little small businesses that don't have the need to take over the world, or eat the market. They still might need growth funding or even sustained funding. to go to the next level or to innovate. And that's very different risk profile to a startup that's just started, right, in the last 2 years.
Absolutely. So the last question I have, and if there are any other questions from folks watching, put those in, because time is coming to an end here. But the last question I have is, in many sort of VC circles, you hear people say, I have capital, but I have nowhere to invest it. What do you say to that sort of sentiment? I've heard that, time and time again. What do you really say to that sentiment?
I'd say try revenue-based financing and see how that makes the market so much bigger. The thing that's killing it, like, venture capital is a precision instrument, right? It's built for a particular type of venture with a particular growth profile and a particular growth market. And that's like, it needs to be like $1 billion market potential. You need to be able to have like 70% market share. And then there's like the other criteria, in particular, like the health tech or green tech or whatever, right? There's this niching down. So I would say, even within your niche, if you change the financial instrument, you might actually find many more ventures applicable to invest in, because even if you grow a company and it's not $1 billion market, you can still be extremely profitable as an investor and as a company through revenue-based financing.
Yeah, because you don't need to have an exit, you see. So that's exactly the key thing about it. So
it just changes the dynamics.
See, that is the other thing too, right? If I invest in an angel or VC, I would want a startup to start paying a lot of tax. Why? Because it increases its valuation. But this is not something that, a startup wants to do, right? Because everything is driven in trying to push the valuation up so that you can find, I guess, a bigger sucker to buy you out, right? So this is the problem that, you have with, with that kind of a model. There are other things we could talk about too, in terms of like, how do we make sure that, the companies we invest in are reporting their revenues to us and they're not hiding their books and stuff like that, as it happens in Asia and elsewhere in the world rampantly. Countries where we operate in, where there are GST or VAT, we basically use that as the reporting mechanism and use the tax office as the police for us to basically make sure that, they are being honest.
Yeah. But again, if you're impact driven, usually there's a at the core of you, right? There's this innate drive to do good. So that's, for us, that's a big trust factor in working with people. Because in the end, we're all people, we're human.
Yeah, absolutely. So, thanks so much for being here. I want to end off just by saying something and then asking for each of you to to give your final words. And that is, the world right now is at this interesting place, right? There's so much amazing things happening. We have much less poverty and much less hunger, etc. But we also have climate change and inequality, and whilst extreme poverty is low, there's still a lot of poverty. And so in terms of thinking about the future of funding, what is it that you'd like to sort of end off with? For those people that are watching, or those that are watching the recording, with that context in mind.
You go first, Clarence.
Yeah, so when I look at all the 17 SDGs, education, equality, water, everything, right? All of it is noble and great, but without funding, none of this could actually work, right? So eliminating poverty, I think, is priority, right? Without that, then nothing else seems, really to be able to work that, easily, because you need funding for it. And this is why we're doing EPIC. So that, I guess the answer to your question is that, we're trying to eliminate poverty by harnessing on the abundance that's been created by technology, and so that we can scale and grow it exponentially. And we obviously can't do it alone, and hence that's why we want more people to be able to join us and replicate what we're doing. Join us or replicate what we're doing, right? Which is open EPIC. Ellie?
For me, it's really around what I would wish for everyone to realize, is that the investor tag could be yours as well. And I think most people who are watching this, they probably already have a pension fund, which means they're already an investor. I think realizing that you have the power to decide where you put your money and who you help on a daily basis, whether that's through what you purchase and consume, where you shop, where you put your pension funds or your savings, what banks you work with, or what investments you make. I think that's where the power sits of helping each other create a better world. I think that awareness starts on your personal basis, on your own level. So I wish for everyone to become empowered and do that. Remind their MTP.
Perfect. So thank you to the two of you for joining, for being, amazing members of the OpenExo community, for what you're doing. For everyone who's watching, go check out epichub.org and join them. Ellie and Clarence, it's been a pleasure chatting to you over the last hour, and we'll see you again soon.
Thanks,
All right.
Kevin.
Thank you so much, guys.
Awesome.
Thank you, Kevin. All right.
Bye-bye. So that was Clarence and Ellie from Epic speaking about the future of funding. To all of you who joined us, thanks so much. I do see that there are some questions that came in right now at the end. So hopefully we'll jump onto those platforms and answer them. Just another reminder that those events that are coming up, you can see right here on my right-hand side. So do join us on the 5th of June. It is a Saturday, an early morning, CST, talking about the future of learning for kids. Thanks so much. And everybody, thanks for joining us. Have a great weekend.